I have always said that the market is never wrong, only opinions are. And nowhere does the truth reveal itself more clearly than when a man tries to mark his support levels. You see, most traders do not fail because they cannot draw a line. They fail because they do not understand what that line represents. Tell me, when you mark a support level, are you marking a price or are you marking behavior? Now think about that for a moment. A support level is not a number on a chart. It is a memory. It is the place where demand once proved itself stronger than supply. And the mistake most men make is they treat it as a fixed point, like a wall carved in stone. But the market is no stone structure. It breathes. It shifts. It deceives. So why would you expect precision where there is none? When I used to study the tape, I wasn't looking for lines. I was watching how prices reacted. Where did they hesitate? Where did they refuse to fall further? That is where support begins. Not at a single price, but in an area. Do you see the difference? A novice marks a line. A seasoned trader marks a zone. And that distinction alone can save a man a great deal of money. Now let us go further. When price approaches a level where it previously found support, what should you expect? Should it bounce immediately? That is what the crowd hopes for. But the market has a way of disappointing the majority. Often, price will pierce through that level, just enough to shake out the weak hands before revealing its true intention. So if you are placing your support exactly at the lowest wick, you are not reading the market. You are reacting to it, and reaction is the enemy of profit. Instead, you must observe clusters. Look left on your chart. Where did price spend time? Where did it consolidate before moving higher? That is where real support lies. Not in a single dramatic spike, but in the quiet agreement between buyers and sellers. The market leaves footprints, but only for those patient enough to see them. Let me ask you, when price returns to a support zone, do you watch how it arrives? Because that matters more than the level itself. If price drifts slowly into support, with declining momentum that tells a story, it says sellers are losing strength. And when that happens, support has a higher chance of holding. But if price crashes into that same level with force, with urgency, with fear, then what? Do you still expect the same outcome? Of course not. Because when sellers are aggressive, they do not stop simply because a line exists on your chart. That is not how markets work. That is how amateurs think. You see, support is not about prediction. It is about probability, and probability is shaped by context. Now here is something most traders overlook. A support level becomes stronger the more times it is respected, but only up to a point. After repeated tests, the buyers at that level begin to weaken. Their orders are absorbed. And when that happens, what follows? Breakdown. So if you are buying blindly at support, just because it has held before, you are not trading. You are hoping. And hope, as I learned the hard way, is a very expensive habit. Instead, you must ask yourself who is in control at this level right now. Not yesterday. Not last week. Now. Watch the candles. Watch the reactions. Are buyers stepping in with conviction? Or are they hesitant? Is price rejecting the level sharply, or is it lingering, struggling to rise? These are the details that separate a thinking trader from a guessing one. And here is where discipline comes in. You do not mark support levels to justify a trade. You mark them to prepare for one. There is a difference. Preparation means you wait. You observe, you let the market confirm your idea. But most men cannot wait. They see a level and they act. And when a trader acts without confirmation, what follows is usually regret. I learned long ago that the market pays those who are patient, not those who are eager. Now let us talk about precision again. You will often hear traders argue about the exact price of support. But I tell you, precision in trading is an illusion. The market operates in ranges, not exact numbers. So instead of drawing a thin line, think in terms of a band, a region where interest exists. This small shift in thinking changes everything. Because when you allow for flexibility, you stop being shaken out by minor fluctuations. You stop reacting to noise, and you begin to see the bigger picture. And the bigger picture is where the real money is made. Another thing you must understand is that support is not permanent. What was once support can become resistance. And when that shift happens, it tells you something important about the market's character. If price breaks below support and then returns to it, what do you do? Do you still treat it as a buying opportunity, or do you recognize that the roles have changed? The market is always communicating. The question is, are you listening, or are you imposing your own beliefs onto it? Because when a trader clings to outdated levels, he is not trading the market as it is. He is trading the market as he wishes it to be. And that is a dangerous game. Now let me give you something practical. When marking support, start with higher time frames. Why? Because they carry more weight. A support level on a daily chart means more than one on a 5-minute chart. It reflects broader participation, larger money, stronger intent. Then refine it. Drop to a lower time frame and observe how price behaved within that zone. Did it form a base? Did it show rejection? This is how you build confidence in your levels. Not by guessing, but by studying behavior. And once your level is marked, your job is not finished. In fact, it has just begun. Because marking support is only the first step. The real skill lies in how you react when price reaches it. Do you wait for confirmation? Do you manage your risk? Do you accept that sometimes, despite all your analysis, the level will fail? Because it will. And when it does, what separates the professional from the amateur is not accuracy, it is response. A professional accepts the loss, reassesses, and moves on. An amateur argues with the market, holds on to a losing position and hopes for a reversal. And hope, as I have said, has no place in this business. So as you go back to your charts, I want you to remember this support is not a line you draw. It is a story you read. It is the record of where buyers once took control, and whether they are likely to do so again. And if you cannot read that story, then what exactly are you trading? The strength of support is not decided by the line you draw, but by the way price behaves as it approaches that line. Most traders never stop to consider this. They see a level. They remember it held before, and they assume it will hold again. But let me ask you, does the market repeat itself blindly, or does it reveal its intentions through behavior? When price moves toward a support level, it is telling you a story long before it gets there. The question is whether you are paying attention to that story or ignoring it in favor of your expectations. If price drifts downward slowly, step by step, with smaller candles and fading momentum, something important is happening. Sellers are present, yes, but they are not in control. Their pressure is weakening. The market is easing into that level, not attacking it. And when that happens, support has a greater chance of holding, because there is no urgency behind the selling. But consider the opposite. What happens when price rushes toward support with large, aggressive candles? When it falls sharply, almost violently, as though it cannot wait to get there. That is not weakness. That is strength, but on the side of the sellers. And when sellers are that determined, a support level becomes less of a barrier and more of a target. You see, the same level can produce two entirely different outcomes depending on how price arrives. And yet most traders ignore this completely. They mark their support. They wait for price to touch it, and they act. No questions asked. But trading is not about reacting to a price. It is about interpreting behavior. If you fail to do that, you are no different than a man tossing a coin and calling it analysis. Now think about cause and effect. When sellers push price down slowly, they are testing the waters. There is hesitation. There is uncertainty. And when uncertainty exists, it leaves room for buyers to step in. But when sellers push price down aggressively, they are not testing. They are committing. And commitment changes everything. Because strong selling pressure does not disappear simply because a level has been reached. So what should a thinking trader do? He observes before he acts. He studies the speed of the move, the size of the candles, the rhythm of price. He asks himself, is this approach controlled or impulsive? Is the market calm, or is it emotional? Because emotion, especially fear, drives momentum. And momentum does not stop easily. If you begin to see this clearly, your decisions will change. You will stop buying simply because price has reached support. Instead, you will wait to see how it reacts. Does it hesitate? Does it reject the level with strength? Or does it linger, struggling to rise? Because when price hesitates at support after a strong drop, it is not a sign of strength. It is a warning. It tells you that buyers are not stepping in with conviction. And when buyers lack conviction, support becomes fragile. But when price touches support after a slow decline and immediately shows rejection, sharp moves upward, strong buying pressure, that is different. That is confirmation. That is the market showing you that demand is still present. And this is where patience becomes your greatest ally. You do not need to predict what will happen at support. You need to wait for the market to show you. But most traders cannot wait. They fear missing the move. And in that fear, they act too soon. And when a trader acts too soon, what follows is usually the same story. He enters before confirmation, the level breaks, and he is left wondering what went wrong. Nothing went wrong. He simply ignored the approach. Because in trading, how price moves is just as important as where it moves. A slow decline into support often tells a very different story than most traders are willing to see. At first glance, price is still falling, and to the untrained eye that looks bearish. But let me ask you, does every downward move carry the same weight, or is there a difference between pressure and hesitation? When price begins to drift lower gradually, candle by candle, something subtle is taking place beneath the surface. The market is not being pushed down with force. It is simply easing lower. Sellers are present, yes, but they are not aggressive. They are not overwhelming the market, and when that happens, it suggests that the selling pressure is losing strength. Now think about cause and effect. When sellers are strong, they act with urgency. Price falls quickly, sharply, with conviction. But when that urgency disappears, when the movement becomes slower and more measured, it tells you that the willingness to sell at lower prices is fading. And if sellers are losing interest, what must eventually happen? Buyers begin to regain control. But here is where most traders misunderstand the situation. They see price approaching support and assume that the level itself will cause the reversal. But the level is not the cause. It is the stage. The real cause lies in the behavior of the participants leading up to that moment. If price drifts into support slowly, it often means that the market has already begun to balance itself before even reaching the level. Sellers are no longer dominant. The downward move is no longer driven by fear or urgency, and without that pressure, the likelihood of a strong breakdown decreases. Now consider what this means for your decisions. If you recognize a slow, controlled decline into support, you do not rush in blindly. You prepare. You become alert. Because this type of movement increases the probability that the level will hold. But probability is not certainty. So you wait for the market to confirm what it is already hinting at. You watch how price behaves as it touches the zone. Does it stall? Does it begin to reject lower prices? Do buyers step in with visible strength? Because when a slow decline meets a strong reaction at support, that is where opportunity begins to take shape. But if you ignore the nature of the decline, you miss the context entirely. You see, many traders focus only on where price is. Very few pay attention to how it got there, and yet, the journey contains the very information they need to make better decisions. Let me ask you, would you trust a support level the same way if price had been collapsing into it with panic? Of course not, because panic brings momentum, and momentum tends to continue. But a slow decline lacks that energy, it lacks that urgency, and without urgency, the market is more likely to pause, to stabilize, to reverse. This is not theory, it is observation. When you begin to notice these differences, your perspective changes. You stop treating all support levels equally. You start weighing them based on the behavior leading into them. And that is where understanding begins to replace guessing. Now here is something practical you can apply immediately. The next time you mark a support zone, do not just wait for price to reach it. Study the approach. Look at the size of the candles. Notice the momentum. Ask yourself, are sellers pressing or are they fading? Because when sellers fade, they leave a vacuum, and markets do not like vacuums. They tend to fill them with movement in the opposite direction. An aggressive drop into support is a very different creature from a slow decline, and if you fail to recognize that difference, the market will teach it to you, usually at a cost. You see, when price moves fast, it is not drifting. It is being pushed. And when it is being pushed, there is intent behind it. Now let me ask you, when sellers are acting with urgency, do you really believe they will stop simply because price has reached a level you have drawn? That is the assumption many traders make, and it is where they go wrong. When price falls sharply into support, with large candles and very little hesitation, it tells you one thing clearly: sellers are in control. Not quietly, not uncertainly, but decisively. They are willing to sell at lower prices without waiting. And when that kind of pressure is present, a support level becomes vulnerable. Because support, at its core, depends on buyers stepping in with enough strength to absorb that selling. But if the selling is too strong, too fast, too aggressive, then what happens? Buyers get overwhelmed. Now consider the cause and effect of that situation. When aggressive selling drives price downward, it often triggers fear in the market. Traders begin to exit positions. Stops get hit. Liquidity is created. And all of this adds more fuel to the downward move. So by the time price reaches support, it is not arriving calmly. It is arriving with momentum behind it. And momentum has a tendency to continue, not reverse. This is why many support levels fail, not because they were poorly drawn, but because they were approached incorrectly. The trader sees the level, but ignores the pressure behind the move. And when you ignore pressure, you ignore reality. You see, the market is not obligated to respect your levels. It only responds to order flow, buyers and sellers. And when sellers are aggressive, they do not pause politely at support. They test it. They push through it. They look for liquidity beyond it. So what should you be watching instead? Watch the speed. Watch the size of the candles. Watch how little price pulls back during the drop. Because when price moves in a straight line towards support, it tells you that there is no meaningful resistance from buyers along the way. And if buyers have not shown up yet, why assume they will suddenly appear at your level? That is not analysis. That is hope. Now here is where discipline separates one trader from another. When you see an aggressive move into support, your job is not to predict a bounce. Your job is to recognize the risk. You step back. You become cautious. You wait for the market to prove that the selling pressure has slowed down or been absorbed. Because until that happens, the level is not support. It is simply a point being tested. Let me ask you something. How often have you seen price break below support, only to reverse afterward? It happens often. But the reversal does not happen because the level held. It happens because the selling pressure finally exhausted itself. And that exhaustion does not come from the level. It comes from behavior. So if you are buying into aggressive selling without waiting for signs of exhaustion, you are stepping in front of momentum. And momentum is not something you fight casually. Instead, you must let the market show you a shift. Do the candles begin to shrink? Does the pace of the decline slow down? Do you start to see rejection from lower prices? These are the signs that sellers are losing control, and only then does the idea of support begin to regain meaning. Until then, you are not looking at a strong level. You are looking at a level under attack. And a level under attack is far more likely to break than hold. A support level does not become stronger simply because it has been tested many times. That is a comforting belief, but it is not how the market operates. In fact, the opposite is often true. The more a level is tested, the more it begins to weaken. Now let me ask you, why would that be? Because every time price touches support, buyers step in. They place their orders. They absorb the selling. And for a while, the level holds. But those buy orders are not infinite. They are consumed with each test. And when they are consumed, what remains? Very little to defend the level. You see, support is not a magical floor. It is simply an area where demand once exceeded supply. But demand must be renewed each time price returns. And if that demand begins to fade, the level loses its strength. Now consider the behavior of traders. The first time price reaches a support zone, it often reacts strongly. Buyers are confident. The level is fresh. There is little doubt. But by the second or third test, something changes. Some of those buyers have already taken their profits. Others become cautious. And new buyers are not always eager to step in at the same price. So what happens? The reactions become weaker. Instead of sharp bounces, you begin to see smaller moves upward. Instead of quick rejections, price lingers near the level. And this lingering is not a sign of strength. It is a sign of pressure building. Because while buyers are hesitating, sellers are still active. Let me ask you, what do you think happens when a level is tested repeatedly without a strong push away from it? It gets worn down. Each test is like a hammer striking the same point. At first, nothing breaks. But over time, the structure weakens. And eventually, it gives way. This is the part most traders fail to see. They assume that because a level has held before, it will continue to hold. But they do not account for the fact that the conditions are changing with each test. Now think in terms of cause and effect. When support holds strongly, price moves away with conviction. That creates space. It creates imbalance. But when support is tested again quickly, without a strong move away, it tells you that buyers did not gain control for long. Sellers are still present, still pressing. And when that pressure persists, the outcome becomes more predictable. Breakdown. But here is where discipline matters. You do not assume the level will break. You observe how it behaves under pressure. Are the bounces getting weaker? Is price spending more time at the level? Are buyers failing to push price higher with strength? These are the clues. Because the market does not announce its intentions with words, it reveals them through behavior. And repeated tests are one of the clearest signals that something is changing. Now let me give you something practical. When you identify a support level that has been tested multiple times, shift your mindset. Stop seeing it as a safe place to buy. Start seeing it as a level under stress. And when a level is under stress, you become cautious, not confident. You wait for confirmation. You watch for signs of failure. Because when support finally breaks after multiple tests, the move that follows is often sharp. Why? Because once the remaining buyers are exhausted, there is very little left to stop the selling. And all those traders who kept buying the level, they become trapped. Their exits become fuel for the move downward. So instead of joining the crowd at a weakening level, you step back, you observe. You ask yourself, is this level holding because it is strong, or is it holding because it has not yet had the chance to break? Because there is a difference, and that difference is what separates a trader who reacts from one who understands. Most traders are drawn to dramatic moments on the chart. The sharp drop, the long wick, the sudden reversal. It catches the eye. It feels important. And so they mark their support at that exact point, believing they have found something precise, something reliable. But let me ask you, does the market truly build its foundation on moments of panic or on periods of agreement? Because a sharp wick is often nothing more than a moment of imbalance. Price moves quickly, liquidity is taken, and then it snaps back. It is emotional. It is reactive. And while it tells you that buyers stepped in at that moment, it does not tell you that they are committed to defending that exact price again. Now think about consolidation. When price pauses, moves sideways, and spends time within a range, something very different is happening. Buyers and sellers are interacting in a more balanced way. Orders are being exchanged. Positions are being built. This is not panic. It is negotiation. And where negotiation takes place, structure is formed. So when you look left on your chart and see an area where price stayed for a while before moving higher, that is where real support begins to reveal itself. Not because of a single reaction, but because of repeated acceptance. The market spent time there. It agreed on value there. Let me ask you, what carries more weight, a single rejection that lasted a moment, or a range where price spent hours, even days, building positions? The answer is clear, but many traders still choose the former, because it feels precise. But precision in trading is often misleading. The market does not operate on exact numbers. It operates on zones of interest, and consolidation zones represent those areas far better than isolated spikes. Now consider the behavior behind it. A sharp wick usually forms when price moves too far, too fast, and is quickly rejected. It often reflects stop hunts, sudden bursts of orders, or emotional reactions. But once that moment passes, the market moves on. There is no guarantee that the same level will hold again, because there was no sustained activity there. But consolidation is different. When price stays in one area for an extended period, it means participants are comfortable trading there. Buyers accumulate positions. Sellers distribute. volume builds, and when price eventually moves away from that area, it leaves behind a footprint of real interest. That footprint becomes your support. Now think in terms of application. When you mark support, instead of placing your line at the lowest wick, widen your view. Look for the base. Look for the range where price paused before moving upward. That is your zone. That is where buyers showed commitment, not just reaction. And when price returns to that area, you are not relying on a single moment. You are relying on a structure that was built over time. This changes how you see the market. You stop chasing precision and start understanding behavior. You stop reacting to noise and start focusing on where meaningful activity took place. Let me ask you, how often have you placed your support at a wick, only to see price break it slightly and then reverse? That is not the market failing your level. That is you placing your level too narrowly. Because the real support was not the wick, it was the area around it. Now here is something to carry with you. When price leaves a consolidation zone with strength, it often creates an imbalance. And when the market returns to that area, it tends to react again. Not because of memory alone, but because of unfinished business. Orders remain. Interest remains, and that is what gives the level its strength. Most traders believe they are reading the market, but in truth, they are remembering it. They look at a chart, see where price reacted before, and assume it will behave the same way again. But let me ask you, does the market owe you consistency, or does it demand your attention to what is happening right now? Because there is a quiet danger in relying too heavily on past behavior. A level that held yesterday may not hold today. A support that once produced a strong bounce may now produce nothing at all. And yet, traders continue to act as though the past guarantees the future. They trust the level more than they trust the evidence in front of them. That is where the trouble begins. You see, the market is not static. It is constantly shifting, constantly adjusting. Participants change. Conditions change. Sentiment changes. And when these things change, behavior changes with them. So if you are looking at a support level and assuming it will hold simply because it held before, you are not analyzing, you are assuming. Now think about cause and effect. When a support level holds in the past, it is because buyers stepped in with strength at that time. But those buyers are not obligated to return. Their positions may already be closed. Their interest may have shifted. And if they are no longer present, what exactly is supporting the level? Nothing but your expectation. An expectation is not a strategy. Let me ask you, when price approaches a level you have marked, do you observe what is happening in the moment? Or do you act based on what happened before? Because the difference between those two approaches is the difference between reacting and understanding. A thinking trader watches the present. He studies how price behaves as it reaches the level. Are buyers stepping in with strength? Is there hesitation? Is there rejection? Or is price moving through the level as if it barely exists? These are the questions that matter, because the market speaks in real time. And if you are not listening to it now, then what exactly are you listening to? The past cannot execute your trade. Only the present can. Now this does not mean you ignore historical levels. They are important. They give you context. They tell you where the market has reacted before. But context is not confirmation. And too many traders confuse the two. They see a level, they remember its significance, and they act immediately. But acting without confirmation is nothing more than educated guessing. And guessing, no matter how informed, is still guessing. Instead, you must combine the past with the present. Mark your levels, yes. Understand where the market has found support before. But when price returns to that area, shift your focus. Stop looking left. Start looking at what is unfolding in front of you. Let me ask you something simple. If price breaks through your support level without hesitation, what does that tell you? It tells you that the conditions have changed. And if conditions have changed, then your previous assumption is no longer valid. This is where flexibility becomes essential. A rigid trader clings to his levels. He believes in them, he defends them. But the market does not reward belief. It rewards adaptability. And the moment you refuse to adapt, you place yourself at odds with reality. Now consider the practical side. When price reaches support, wait. Observe the reaction. Do not rush to act. Let the market show you whether buyers are present or absent, because the presence of buyers is what creates support, not the line itself. If buyers step in with strength, you have confirmation. If they do not, you have information, and both are valuable, but only if you are paying attention. Because when you act based on the present, your decisions become grounded. They become logical. But when you act based on the past alone, you are trading memory, not reality.